Let's get right to the floor show. Joining me now, Market Rebellion co-founder Pete Najarian and Market Rebellion chief market strategist Marc LoPresti. You know, you two trade through market sunny days and market hurricanes. So let's call this one clouds on the horizon. John Macy's comes to mind after it warned the luxury consumer out there has become more discriminating. I guess you could read that as worried. Jobless claims rose slightly more than expected last week. So how much longer can Wall Street climb this wall of worry?
Well, it's an interesting question because of the fact that every day we're waiting for the next big event, right? The next catalyst. And I think obviously the thing that we're staring at right now, we've stared at it all week, has been about Mr. Powell. And what is the Fed going to actually release to us as we get closer and closer? We're right there bumping up against it now for Friday. I think that's what we've really been looking for. I know the earnings cycle has been amazing. It's been absolutely incredible this year, once again, in this particular quarter. But I think it's more importantly now just focusing on the Fed. That is what about 80% of what the markets are looking at right now. And it's a matter of, do we think it's a quarter? Do we think it's 50? Everybody's got their opinions on that. But I can tell you, I think Jay Powell has given us the blueprint. It will be 25. And if it's more than that, I think you got to wonder, are we going to be more concerned because of that? Or is the quarter enough?
Yeah, is the quarter point enough? Marc, let's just move it right to what does well if it's a quarter of a point. I mean, you start to see this sell-off with the markets at the moment. I mean, It's not huge, but it's steadily gone down.
Yeah, the sell-off's accelerated a bit today, but I wouldn't read too much into this, Liz. Think about how we performed coming up to this point with the much anticipated...
Which we showed you.
10 a.m., which we showed. And look, the reason we're not going to get 50 basis point cut tomorrow from Jay Powell is because that would signal there is no soft landing. Something's really, really wrong. So I think my money's definitely on 25 basis points tomorrow, for sure.
Okay, that's what it's on. Where is your money in? Where are you putting it right now?
Well, so listen, after watching the resiliency of the American consumer, which has shocked everybody, myself included, specialty consumer discretionary names, I think names like in the earnings we saw so far this week, TJ Maxx, Walmart, Target, companies that have managed to continue to attract consumers to lower prices. As the Fed cuts rates, cost of capital comes down. We've already seen some prices in core goods starting to come down. That spending in those particular names is going to continue and maybe even accelerate as people like to go and buy not just what they need to have, but what they want to have.
Yeah, I mean, TJ Maxx has just been on a tear at 33% over the past year. Pete, what about you? When you look at the landscape at the moment where, okay, let's expect 25 basis points at least at the September meeting, what looks tasty to you out there in the markets?
I like the way you put that, tasty. I think the tastiest that I see right now is certainly in the financials. And when I say that, I mean the investment banking side of the financials. I'm talking about Goldman Sachs and Morgan Stanley and Citi and JP Morgan. When you look at some of the profits there, Liz, it's been absolutely incredible. And the investment banking side, you're talking about 50% all the way up to 150% when you look at Goldman Sachs. These are huge numbers that they've been able to put up. I don't think it's over in the first half of the year. That's looked great. I think it's going to look even better in the second half of the year. I think when we talk about M&A and all of the different things, IPOs, all of that involved into the investment banking world, that's an absolute home run. I'd also even add to that, you could go into energy. You could go into energy, and I'm not talking about oil. I'm actually talking about uranium. The demand for uranium is going to be absolutely off the charts, not necessarily in the next 6 months even, but over the next 3, 4, 5 years, when you consider all of the demand that you're going to be getting from those data centers, from AI, all of that, it is going to be in demand, and you've got to have something that's very sustainable. It can't just be wind. It can't just be solar. It's got to be nuclear, and I think we're going to see more and more of that, and I think names like Cameco and others certainly could do very well off of that. They had a great start to the year. They've kind of paused for a while now. I think that's still an area that you should keep your eye on.
Chip today, though, chips today and the stocks getting hammered here. Marc, do you get the sense that this is just one of those days where people are taking profits ahead of what could be the news that's expected?
Yeah, 100%. I'm not reading into too much of this sell-off. And, of course, what gets sold off when people start to take profit, the stuff that has gone up a lot, the risk capital, the mega tech stocks. Talking to traders on the big hedge fund desks as we try to do, over 300 of the hedge funds that we've spoken to that have $1 trillion or more, excuse me, $1 billion or more in AUM, still have mega cap tech among their top 20 holdings. We don't expect that to change going into the end of the year.
Let me just show you the Dow 30, though. The laggards themselves. It is Intel, it is Microsoft, it is Amazon, and those are the three, but Intel is the worst performer. And it's just important to note, certainly, that the chips have had an incredible run up themselves. So, you know, trees do not grow to the sky, people. Pete, Marc, great to have you both. Thank you very, very much. Well, this is unbelievable. It was a pandemic.